Things to consider before selecting any mutual funds for investment. Number 1, goals. This is the basic. When you invest in a mutual fund, keep your target in mind, like what is the purpose of this investment, how long are you planning your investment, and what your return expectations. In the absence of a clear goal, you may want to exit your investment for small fluctuations. A goal can be short term, like purchasing utility goods, down payment for a house, or international holiday. It can be for long term, like retirement and college education for children. Depending upon why you are investing, you will be able to select the mutual fund type. It can be debt mutual fund, equity mutual fund, or hybrid mutual fund. For instance, for some investors, the main investment objective is to gain capital on their investments. For others, it may be tax saving. Number 2, risk. Risk comes from not knowing what you are getting into. Before choosing a mutual fund, the investor should analyze the risk associated with the investment, and he has to check if the risk is comfortable or not. Equity mutual fund investments are subject to market fluctuations. Therefore, equity-oriented portfolio could witness volatility as well in the short term. But note that the returns can be substantially higher than other types of funds. This type of funds might be suitable for long-term aggressive investors. Debt mutual funds are comparatively more stable, but the returns could be lower than the equity funds. It might be suitable for conservative investors. Number 3, liquidity. Investor should know when he may require investment. That is, if the need is in the near future, it's not for equity mutual funds. This is because it may not provide the expected returns. If you can stay with the investment for 1 year more, then equity mutual funds can generate the expected returns. It is important because compounding works best when money is left untouched for long periods of time. So if you want to raise money for a short-term period, go for liquid funds. Number 4, investment strategy. It holds a crucial place in the success of your investment portfolio. Investment strategy, also referred to as the investment approach. It is a strategy that the fund houses adopt to make all the investment decisions. If the investment strategy of the fund house is not in line, a conflict of interest will arise, and ultimately leading to you exit the investments at undesirable prices. Number 5, fund performance. Remember that fund performance matters. It should be considered for a reasonable time frame. This is to ensure that the investments have gone through multiple market cycles. This would enable consistent return over a period. In case the fund has not been able to beat its benchmark over 3, 5, 7 or 10 years, it is reasonable to believe that the fund might not be good investment. While analyzing a fund's performance, it is important to check the performance details of the fund manager or the fund management team. A strong, stable, experienced fund management team with reasonable tenure and proven track record would prove beneficial for investors. Number 6, expense ratio. The expense ratio is the commission or the fee charged from the investors for a proper management of their investments. It is basically the fund manager's fee that is laid upon all investors for ensuring profits across the investments. As an investor, you must target mutual funds that have a lower expense ratio. This is because the percentage may seem quite small, but when calculated across your total investment portfolio, it will definitely have larger impact. Number 7, entry and exit load. Entry load refers to the fee charged by fund houses from investors. Exit load refers to the fee charged at the time of exiting a mutual fund scheme. This is chargeable only if investors exit within a short period. This is to discourage quick exit and immediate outflow of cash from fund houses. The entry load has been removed by most fund houses. As an investor, you must look out for mutual fund schemes that have zero or minimal entry and exit load. Number 8, taxes. When you as an investor make money from your investment, it is taxable as per Income Tax Act. When equity funds units are redeemed, the returns are taxable as per the period of holding. For equity funds and long-term capital gains are taxed at 10% over and above the exemption limit of Rs 1 lakh. Short-term capital gains are taxed at 15%. For debt funds, indexation benefit is available for the capital gains. For these funds, a holding period of 36 months or more is considered as long-term. Any holding period which is less than 36 months is treated as short-term and the gains are taxable. There are two types of plans available for a mutual fund scheme: direct and regular. Direct and regular funds are different versions of the same plan. Investors can directly buy required NAV units from a concerned fund house. In the case of regular, the units have to be purchased through a commissioner or broker. A key difference between the two is that returns are slightly higher in a direct mutual fund as no commission expenses are incurred. Depending upon the asset management company and the brokerage firm, This commission varies between 1 to 1.25%. Number 9. AMC track record. An asset management company or AMC, also known as fund house, is the company which manages a mutual fund scheme. For example, HDFC Mutual Fund is the name of the AMC that manages schemes like HDFC Equity, HDFC Top 100 or HDFC Small Cap Fund. Many decisions are made at the AMC level by the Chief Investment Officer of the AMC. A poorly selected stock is often present in several schemes owned by an AMC because the selection has been made at AMC level. It is important to check the track record of the AMC while selecting a mutual fund scheme. Number 10. Understand the difference between fund types. There are a handful of different types of mutual funds that generally align with different investing goals and objectives. Here are a few examples. Large cap funds. These funds invest in large, widely held companies with market capitalizations worth $10 billion or more. Small cap funds. These funds tend to invest in companies with market capitalizations between 300 million and 2 billion. Value funds. Value funds consist of stocks that are perceived to be undervalued. These are typically well-established companies but are considered to be trading at a discount. Growth funds. Growth funds largely invest in companies that are rapidly growing and whose primary objective tends to be capital appreciation. They may have a higher price to earning ratio and have greater potential for long-term capital appreciation. Income funds. Some funds pay regular income. This can come in the form of dividend or interest. Thank you so much for watching this video. See you in the next video.